Good afternoon. My name is Daniel Broby. I'm Professor of Financial Technology at Ulster University. Firstly, I'm very sorry I can't be at the conference with you in person. Obviously, that would be the most fabulous thing to do. However, I'm also unable to be with you virtually because actually this time slot clashes with me supposed to be on a flight to the island of Jersey. So many apologies for that, but what I've done is I've recorded a short video that just tells you a little bit about the chapter that Alexander Belinsky and myself have contributed for publication in Artificial Intelligence for Capital Markets, the CRC Press Taylor Francis publication that comes from the conference proceedings. The title of our subject chapter is Machine Learning and the Optimal Choice of Asset Pricing Model. The abstract pretty much explains what we're trying to look at. We're trying to evaluate the traditional models of price prediction and see what, in terms of forecasting, machine learning can do to effectively add better outcomes to price prediction. As you know, asset pricing is a major area of interest in quantitative finance, and forecasting of that is fundamental to effectively the active asset management industry. But the active asset management industry has been with us for many, many years, and yet machine learning has only really been adapted to it in the last 20 years. So from the perspective of machine learning, I assume because you're in the stream, you're fairly familiar with it, but it's effectively a mechanism to train machines to perform a specific task, handling the data in a specific way. Now that suits itself very well to the quadratic problem that is asset pricing, because we've got also highly dimensional and large volumes of data that allows us to look at the way stocks vary and co-vary, and look at the way that the time series has had these progressions in time, but also importantly, non-linear progressions. So the topics covered in the chapter are fairly extensive, covering all areas of asset pricing and the applications of machine learning, but we divide that into two subsectors: the machine learning from the point of view of penalized linear regression, regression trees, support vectors, and Markov switching, where you've got regime change, and also artificial neural networks, where effectively we've got both feed-forward, recurrent neural networks, ensemble neural networks, and how all of these interplay. From the point of view of asset pricing, you have to have a fundamental understanding of Markowitz's 1952 and how an efficient frontier is created for optimal portfolios. And that efficient frontier is created because of this risk trade-off between expected return, as shown on the graph, and risk as proxied by standard deviation, as also shown on the graph. And because stocks vary and co-vary, that creates effectively an efficient envelope which reflects the way that the correlation matrix results in the determination of the optimal number of the optimal weight of portfolios in a portfolio. So, although developed independently, the capital asset pricing model is effectively that mathematical trade-off between risk and return, and developed by Traynor, Sharp, and Lintner in the past, and in that respect, all of that is in the chapter pretty much the introduction to how we can apply machine learning to it. So if we think of what the CAPM says, effectively the formula down there, think of it more like a linear regression between, as I said, risk and return. And that therefore allows a model to represent that trade-off also relative to the risk-free rate. That is a single factor model, if you think about it in terms of factors, the most dominant factor then being the market factor. from there, asset pricing developed to focus on multi-factors, where we were able to take that market factor and subdivide it into further risk factors. And that built on the work of Ross in 1977 arbitrage pricing theory. And because of its simplicity, but also because of the fact that it can decompose risk factors, multi-factor models are used extensively in the fund management industry, particularly so that they can be able to attribute risk to managers who are managing equity portfolios. So there's an extensive literature on all of this subject, and obviously building from Markowitz in 1952. But what is interesting from the point of view of machine learning is the literature on estimation risk. The fact that that efficient frontier in real time actually suffers from the fact that the more variable inputs you put in it, the harder it is to estimate. And the way that that problem has traditionally been solved is through the use of shrinkage to the single index model, so that the parameter inputs are less than all the single stock inputs that would go into a full model. But that again has a number of issues in itself in relation to code movement. And so from the point of view of machine learning, that then becomes one of the big challenges. The chapter goes on to show that actually this isn't new work as such. It's very much the application of work that's been done by other people. But we demonstrate, for example, a test of Farmer and French on a 5-factor model showing the R squared of between 0.91 and 0.93. So as you can see, the model can explain results, but effectively it requires still additional testing, and there's a lot of literature about how, for example, t-statistics should be have a higher bar. If we take, for example, Campbell's work with lucky factors, his paper there. So as a result, to avoid data snooping, and there are a number of issues where the statistical importance has to be raised, and we highlight these issues in the chapter. So what are these challenges? Is the risk premium is a challenge, the functional form is a challenge, as I said, the variable selections, and ultimately the estimation error. So as you can see, the objective of asset managers is to improve the efficient frontier, which is where you can see that dotted line above that, the efficient frontier itself. And therefore, what we're talking about in predictive models is how any one of those 4 challenges can result in an improved Sharpe ratio, coming to another of the contributions from the literature, which is really an improved risk to reward ratio, the way that Sharpe himself described. We also describe the particular different models and how they work, and effectively try to talk people through what the various inputs are, as you can see from these stylized diagrams here. And once we have done that in the chapter, we demonstrate the differences in terms of some back testing. That results in a number of issues. Again, in the chapter, we discuss that. So really, very much this chapter's contribution is in a learning tool where it's taking and explaining the trade-offs that machine learning has, and all the issues like underfitting and overfitting, so that we can find an optimal model. So in conclusion, essentially we've submitted to your conference a chapter to provide a theoretical framework for traditional asset pricing models, and specifically that chapter highlights a lot of limitations, but it also explains the way that machine learning techniques can be used in asset pricing prediction. We conclude that these techniques show promising results dealing with the high dimensional data, and that's exciting because it means that even though we can't necessarily challenge the 0 alpha function of the CAPM or such like, that we can use the risk decompositions effectively to control risk in asset pricing scenarios. So This isn't an empirical paper, it's more a chapter, but what we've done in that chapter is to show various statistical overviews which show what machine learning can do in a financial context. So thanks very much for your time, and I do hope that you enjoy the rest of the conference.